Gold is falling right now, yet some of the biggest institutions in the world are quietly projecting a move towards $6,000 to $6,300. At the same time, silver is exploding higher, outperforming gold in short bursts and attracting serious attention from both traders and industrial buyers. So what's really going on here? Because if you just look at the headlines, it doesn't make sense. On one side, we have gold pulling back, struggling to hold momentum, trading around $4,730 to $4,780 per ounce. On the other side, major banks like UBS, JP Morgan, and others are talking about a path toward $5,900, even $6,300. And silver? Sitting around $75 to $76 per ounce, but moving faster, more aggressively, and in many cases, more unpredictably than gold itself. This is exactly the kind of market that confuses retail investors, but creates opportunity for smart money. Before we break it down, here's what just happened in the last few days. Gold jumps nearly 2%, reaching around $4,749 per ounce in one session. At the same time, silver surged even harder, jumping about 4.7% and continuing its third straight weekly gain. That's not random. That kind of synchronized move tells you something bigger is happening beneath the surface. But almost immediately after that rally, gold started to pull back again. Why? Because this market right now is being driven by two completely opposite forces. On one side, you have strong bullish drivers, and on the other side, you have powerful short-term pressure. Let's start with what pushed prices higher. The biggest factor this week has been geopolitics. A fragile two-week ceasefire between the United States and Iran has reduced immediate tension in the Middle East. That might sound like something that would hurt gold, because gold usually rises when fear rises, but that's only part of the story. Here's what actually happened. Oil prices dropped sharply, in some reports nearly 10 to 12% in a single week. That drop in oil eased inflation fears. And when inflation fears ease, markets immediately start thinking about one thing: interest rate cuts. Right now, traders are pricing in roughly a 24 to 30% chance that the Federal Reserve could cut rates by the end of 2026. And this is where gold comes into play. Gold does not pay interest, so when rates fall, gold becomes more attractive compared to bonds and cash. At the same time, a weaker dollar makes gold cheaper for international buyers, increasing demand globally. That combination, lower oil, softer inflation expectations, and potential rate cuts, is what pushed gold and silver higher this week. But here's where things get complicated. Because even with all of this bullish momentum, gold still couldn't break out cleanly. Instead, it started pulling back again. And that brings us to the second force driving this market: uncertainty. Investors are not fully convinced. The ceasefire between the US and Iran is temporary, it's fragile, and markets know that anything can change very quickly. At the same time, inflation is not fully under control. The latest US data showed inflation still sitting around 3.3%, with a strong monthly increase. That creates a problem, because if inflation stays high, the Federal Reserve may delay rate cuts. And if rates stay higher for longer, gold faces pressure. So right now, gold is stuck in a tug-of-war between a bullish long-term story and a very uncertain short-term reality. And silver? It's reacting even more aggressively to both sides of this equation. That's why you're seeing bigger moves, faster swings, and more volatility. And this is exactly why analysts are saying something very important right now. Yes, there is a path towards $6,000 gold, but that path is not going to be smooth. It's going to be volatile, unpredictable, and filled with sharp moves in both directions. Now, to really understand where gold and silver are heading next, you have to look at the biggest force controlling this entire market right now: the Federal Reserve. Because no matter what's happening with geopolitics, oil, or even central banks, at the end of the day, interest rates decide the direction of gold. And right now, the market is completely divided. On one side, investors are starting to believe that rate cuts are coming. On the other side, the data is still strong enough to delay those cuts. That conflict is exactly why gold is moving up and then immediately pulling back. Let's break this down clearly. The latest US inflation data came in around 3.3%. Now, at first glance, that might sound like good news, because inflation is not exploding higher. But look deeper. Month-over-month inflation jumped around 0.9%. That's a strong increase, and it tells the Federal Reserve one important thing: inflation is not fully under control yet. And if inflation is not under control, the Fed cannot aggressively cut rates. This is where gold faces pressure, because gold performs best in a falling rate environment. Lower rates mean weaker dollar, cheaper borrowing, more liquidity in the system, higher demand for safe haven assets. But if the Fed delays rate cuts or signals higher for longer, then gold loses one of its biggest supports. And that's exactly what we are seeing right now. Markets are pricing in roughly a 24 to 30% chance of at least one rate cut by the end of 2026. That's not a strong conviction. That's uncertainty. And markets hate uncertainty. So what happens? Gold rallies when traders expect cuts, then pulls back when those expectations get weaker. This creates the kind of choppy, volatile movement we're seeing right now around the $4,750 to $4,780 level. Now let's connect this directly to silver, because silver reacts to the same interest rate story, but with even more intensity. Why? Because silver is not just a monetary metal like gold, it's also an industrial metal. That means it depends on economic growth. So while gold is reacting mostly to interest rates and safe haven demand, silver is reacting to interest rates, economic growth expectations, industrial demand, solar, EVs, semiconductors. This makes silver much more explosive. That's why you saw silver jump nearly 4.7% in a single move recently, while gold moved less than half of that. But here's the risk. If the Fed delays rate cuts and economic growth slows down at the same time, silver can fall faster than gold because it gets hit from both sides. Higher rates, bearish. Weaker industrial demand, bearish. This is why silver often underperforms gold during uncertain economic periods. But when everything aligns, lower rates, strong demand, weak dollar, silver can outperform massively. Now here's something most retail investors are missing. Even though gold is struggling short-term, institutional money is not leaving. In fact, many large players are positioning for the opposite. They are preparing for a scenario where inflation stays sticky, growth slows down, central banks are forced to cut rates anyway. This is what's called a stagflation environment. And historically, that is one of the most powerful setups for gold. That's why analysts from major institutions are still holding their targets, around $5,400 on the conservative side, up to $5,900, and even $6,000 in more aggressive scenarios. So now you can see the full picture. Short term, gold is struggling because rate cuts are uncertain. Long term, gold is supported because the system itself is unstable. And silver? It's sitting right in the middle of this tension, amplifying every move. Which brings us to the next critical piece of the puzzle, the role of geopolitics, and why even a temporary ceasefire is not enough to calm this market. Now let's talk about the factor that can change everything overnight, geopolitics. Because while interest rates are driving the slow, underlying trend in gold and silver, geopolitics is what creates sudden spikes, sharp drops, and explosive moves. And right now, the entire market is watching one situation very closely. The fragile ceasefire between the United States and Iran. At first, this ceasefire brought relief to global markets. Tensions eased, oil prices dropped, and investors started pulling money out of panic trades. That's why, initially, gold lost some momentum after earlier gains, because when fear goes down, safe haven demand also drops. But here's where most people get it wrong. This is not a stable situation. This is a temporary pause. Markets know that this ceasefire is only for a short period, roughly 2 weeks, and negotiations are still ongoing. That means at any moment, one headline, one escalation, one disruption in the Strait of Hormuz, and everything changes again. This is why gold is not collapsing, even when tensions ease. Because investors are not fully confident. They are staying cautious. They are holding positions, just in case. And this creates a very unique environment. Gold is no longer reacting just to fear. It's reacting to the possibility of fear returning. That's a huge difference. Now let's connect this to what happened with oil, because oil is a critical link between geopolitics and gold. During the peak of tensions, oil prices surged due to fears of supply disruption. The Strait of Hormuz is one of the most important oil routes in the world. Any threat to it immediately pushes oil higher. Higher oil means higher inflation, and higher inflation usually pushes gold higher. But when the ceasefire was announced, oil dropped sharply, in some cases nearly 10 to 12% in a week. That sudden drop reduced inflation pressure. And as we discussed earlier, lower inflation expectations increase the chances of rate cuts, which is bullish for gold. So now you have a situation where less conflict, lower oil, lower inflation, more chance of rate cuts, bullish for gold. But at the same time, less conflict, less fear, less safe haven demand, bearish for gold. This is why the market looks confused, because both forces are happening at the same time. And that's exactly why gold is moving sideways instead of trending cleanly. Now let's bring silver into this picture. Silver reacts to geopolitics too, but not in the same way as gold. When tensions rise, gold usually gets the first wave of safe haven buying. Silver follows, but often with a delay. And when tensions ease, silver can sometimes fall faster because it doesn't have the same level of safe haven demand as gold. Instead, silver's biggest boost comes when markets start thinking about recovery, industrial growth, manufacturing demand, energy transition projects like solar. That's why silver rallied strongly alongside gold recently, but with bigger percentage moves, because traders were not just reacting to geopolitics, they were also pricing in economic recovery and future demand. But again, this comes with risk. If the ceasefire holds and global growth slows instead of accelerating, silver could quickly lose momentum. So right now, both metals are being pulled in different directions by the same event. Gold is balancing between fear and rate cuts. Silver is balancing between industrial demand and economic uncertainty. And this is exactly why analysts are using words like fraught with danger, because this is not a normal market. This is a market where headlines matter more than trends, where one news update can move billions of dollars in seconds, and where the difference between a rally and a crash can be a single geopolitical shift. So now you understand something very important. Gold and silver are not just reacting to what is happening, they are reacting to what could happen next. And that's what makes this moment so critical. Because the next move in this market will not just depend on data, it will depend on decisions, events, and timing. Now let's move to the most important questions serious investors are asking right now. If gold really has a path to $6,000, who is actually buying? Because markets don't move based on headlines alone, they move based on money. And right now, the biggest players in the world are not retail investors. They are central banks and institutions. This is where things start to get very interesting. Despite all the short-term volatility, central banks around the world have been accumulating gold at an aggressive pace over the past few years. We're talking about hundreds of tons being added to reserves annually. And this is not random buying. This is strategic. Countries are actively reducing reliance on the US dollar and increasing their exposure to gold. Why? Because gold has no counterparty risk. It's not tied to any government. It cannot be frozen, sanctioned, or printed. And after events like the freezing of foreign reserves in recent years, many countries are rethinking how they store wealth. So instead of holding only dollar-based assets, they are diversifying into gold. This is called de-dollarization, and it's one of the strongest long-term drivers behind gold right now. Now think about this. If central banks continue buying, even during price dips, that creates a floor under the market. It doesn't mean gold can't fall, but it means large declines often attract buyers. And that's exactly what institutional investors are watching. Now let's move to ETFs, because this is where retail and institutional flows meet. Gold ETFs had seen outflows earlier when interest rates were high and the dollar was strong. But now, that trend is slowly shifting. We are starting to see signs of inflows returning. And this matters a lot, because ETFs represent accessible exposure for large funds, pension managers, and even retail investors. When ETF inflows increase, it adds buying pressure to the market. And historically, strong ETF inflows have aligned with major gold rallies. Now let's connect this to the current price action. Even though gold pulled back from higher levels earlier in the year, it is still up significantly on a broader time frame. And more importantly, it is holding key levels despite uncertainty. That tells you something. There is underlying demand. Now let's talk about silver in this context. Because silver does not get the same level of central bank support. Central banks don't accumulate silver in the same way they accumulate gold. So silver depends more on industrial demand, investor speculation, supply constraints. And this creates a completely different dynamic. Recently, silver has shown strong performance, rising faster than gold in short bursts. But at the same time, there have been periods where silver ETFs saw declines. That tells you the market is not fully committed. It's trading silver more aggressively, rather than accumulating it long-term like gold. But here's where silver has a powerful edge. Supply. Silver supply has been tight. Mining output has not kept up with demand in certain sectors. At the same time, industries like solar energy and electronics continue to consume large amounts of silver. So if demand stays strong and supply remains constrained, silver can move very quickly, much faster than gold. And that's why some extreme forecasts are much higher for silver compared to gold in percentage terms. But again, higher potential comes with higher risk. Now let's bring everything together. Gold is being supported by central bank accumulation, ETF flows slowly returning, long-term macro uncertainty. Silver is being driven by industrial demand, speculative trading, supply constraints, and both are being influenced by interest rates, dollar strength, geopolitics. This is a complex market, and when markets become complex, they also become dangerous. Because most investors focus on one factor, while the real movement comes from multiple forces interacting at the same time. And this is exactly why analysts are saying, yes, gold can reach $6,000. Yes, silver can move significantly higher, but the journey will not be easy. It will test patience, it will shake out weak hands, and it will reward those who understand what's really driving the market. Which brings us to the final and most important part. What happens next, and how you should think about this market moving forward. So now the final question. What happens next? Because this is the moment where most investors make the biggest mistake. They either chase the rally too late, or they panic during pullbacks. But if you understand everything we've just covered, the picture becomes much clearer. Right now, gold and silver are not in a simple uptrend or downtrend. They're in a transition phase. A phase where the market is trying to decide between two futures. The first scenario is bullish. Inflation remains sticky, economic growth slows, and eventually the Federal Reserve is forced to cut rates. When that happens, the dollar weakens, liquidity increases, and gold becomes extremely attractive. This is the environment where gold can move toward $5,400, $5,900, and potentially even test that $6,000 level analysts are talking about. And in that same scenario, silver doesn't just follow. It accelerates. Because silver benefits from both monetary demand and industrial demand at the same time. That's when you see explosive moves. That's when silver can outperform gold in a very short period. Now let's look at the second scenario. Inflation stays elevated, but the economy doesn't slow enough. The Fed delays rate cuts, interest rates stay higher for longer, and the dollar strengthens again. In this environment, gold struggles, rallies get sold into, and price remains volatile without clear direction. Silver, in this case, becomes even more unstable because it gets hit from both sides. High rates reduce investment demand, and slower growth reduces industrial demand. This is the fraught with danger path analysts are warning about. Not because gold cannot go higher, but because the journey will include sharp corrections, fake breakouts, and sudden reversals. Now, here's the key insight most people miss. Both of these scenarios can happen in phases. The market doesn't move in a straight line. It moves in waves. That means you can have short-term drops inside a long-term uptrend. You can have rallies inside periods of uncertainty. And that is exactly what we are seeing right now. Gold around $4,750 to $4,780 is not weakness, it's consolidation. Silver around $75 to $76 is not stability, it's tension building. And markets tend to move the most after periods like this. So what should you watch next? First, inflation data. If inflation starts trending lower, expectations for rate cuts will increase, bullish for gold and silver. Second, Federal Reserve signals. Any shift in tone toward easing policy will move markets quickly. Third, geopolitics. The US-Iran situation is not resolved. Any escalation can trigger immediate safe haven demand. Fourth, the dollar. If the dollar weakens, gold and silver get a strong tailwind. And finally, institutional behavior. If central banks and large funds continue accumulating gold on dips, that confirms the long-term bullish structure. So here's the bottom line. Gold has a path to $6,000. Silver has even bigger upside potential in percentage terms. But this is not a smooth ride. This is a market driven by uncertainty, macro shifts, and global power dynamics. And in markets like this, the biggest opportunities come to those who stay informed, stay patient, and understand the bigger picture. If you want clear, fact-based updates like this on gold, silver, and the global financial system, make sure you subscribe to the channel and stay ahead of the market.